Welcome back to Dinar Trend Tracker channel. Something unexpected happened with the Vietnamese dong recently, as anyone who has been following the world currency markets can tell you. The Vietnamese dong, the national currency of Vietnam, but what makes it newsworthy for a channel that usually covers the Iraqi dinar, though, when events in Vietnam have the potential to significantly impact emerging market currencies like the dinar. I hope you'll stay with us through this entire video because we're not merely discussing a minor technical adjustment. We're discussing an unseen trigger that went unnoticed by a lot of market observers. Such a change has the potential to affect investor portfolios, trade flows, and the entire Asian continent. Therefore, it may be relevant to your interests regardless of whether you're tracking global macro, emerging market equities flows, or exchange rates. I will explain the dong's history, its current state, its role in Vietnam's economic policy, and its consequences for other regional currencies, including the Iraqi dinar, in a roundabout way. After seeing this movie, you will understand the significance of the subject, what may happen next, and how you should pay attention. Thus, let us begin immediately. To start, the SBV, which is part of the State Bank of Vietnam, secretly updated its official exchange rate mechanism last week. Although it appeared to be a minor technical modification at first sight, the markets quickly recognized that this was no ordinary change. The dong grew stronger at a rate not seen in a few years. Foreign exchange bureaus in Singapore, Tokyo, and London went into overdrive as traders were taken unawares. Although official data are not always apparent, what appeared to be a tiny shift became a huge signal. Our best guess is that the SBV indicated a desire for a stronger currency, gave the dong more leeway in its trading range, and increased transparency. A large number of experts feel this shifts Vietnam's monetary policy away from central planning and toward a system where value is more freely discovered by the market. Well, that's significant. It is a sign of economic confidence, foreign exchange reserves, and global competitiveness when a country like Vietnam, which relies heavily on exports, allows its currency to strengthen. To what end is that relevant? Vietnam has emerged as a major economic power. In the last 10 years, Vietnam has transformed into a manufacturing powerhouse that rivals the best in Asia. Companies in the electronics, mobile device, and clothing industries have moved their production to Vietnam because of the country's cheap workforce, relatively stable government, and favorable trade agreements. Thanks to its booming exports, Vietnam now boasts a trade surplus across numerous industries, a steady stream of FDI, and GDP growth that often hits double digits. So, when the SBV lets the dong get stronger, it's basically sending a message that we're broke. Keeping the currency artificially weak to increase exports is no longer necessary. A stronger currency won't hurt our exports or economy. It is precisely this mental change, the signal as much as the numerical value, that the world's financial markets are responding to. If you think Vietnam is making a major shift in its currency regime, you might want to reduce your exposure to the country. This is the type of signal that might cause investors to reallocate their portfolios. In order to comprehend the peculiarity of the recent event, let us go more into the historical operation of Vietnam's exchange rate regime. For a long time, Vietnam has run a managed float. Every day, or at the beginning of each cycle, the SBV establishes a central reference rate. Prior to granting commercial banks a certain amount of leeway within that rate, there is a central exchange rate, and a band for currency rates in Vietnam's system, according to study. In that system, the government steps in occasionally to control the dong's behavior. Because of its controlled arrangement, the currency is neither fully pegged nor completely floating, unlike the US dollar or the euro. Vietnam is able to maintain stability while enjoying flexibility. In the past, this has meant that the SBV would intervene in the foreign exchange markets, make periodic adjustments to the band, and strive to maintain stable inflation, export competitiveness, and reserve. It now appears as though the band has been widened, which opens up greater opportunity for appreciation. This isn't merely a minor tweak, it represents a substantial change to the regime. Therefore, what is the covert cause of this act? Several elements are converging, according to the available data and expert commentary. To start with, the economic foundations of Vietnam are more solid. Foreign investment is robust, manufacturing is growing, and exports are soaring. Also, there has been a change in the worldwide economic balance. Vietnam stands to gain significantly as manufacturing moves away from China. Thirdly, updating the monetary system. Financial sector modernization, digital payments, and banking reform have been areas of focus for Vietnam's collaboration with international organizations including the World Bank and the International Monetary Fund. It stands to reason that greater monetary flexibility will be possible once the economy has fully developed and become more internationally integrated. Finally, timing is a significant factor. Vietnam may have decided to open up the currency ban today because of the changing dynamics of the global economy, trade flows and supply chains. All things considered, the cover story is more than simply expanding the ban. It is the beginning of a new era in currency policy. Not merely a change in pace, but a change in regime is the true hidden trigger. What the markets are saying, let us be clear. Foreign exchange dealers took note of the dong's strength, and import-export companies revised their contracts accordingly. Also, there were supposedly meetings to discuss regional currency harmonization in a few Asian financial cities, for the simple reason that a change in currency policy by a country like Vietnam, a major exporter of manufactured goods, it has an impact on investor mood, competitive economies, and trade flows. Our best guess is that other Asian currencies started to feel the repercussions of the shift within a few days, not massive, but noticeable. There may be competitive pressure on neighbors who are focused on exports. Currency allocations may be reconsidered by investors. When the value of one currency in an emerging market changes, it can cause a chain reaction. Potentially more competitive competitors in the area may have to act soon. The export engine, supply linkages and currency dynamics of Asia are thus at the heart of this, and it extends beyond Vietnam. Here we will focus on the facts and opinions around the dong to dollar exchange rate. The dong was largely ignored by international financial hubs for a long time because of its reputation as a weak and unimportant currency. However, this change is altering people's views. The US dollar dong rate may be changing, according to report. Public opinion indicates the dong has strengthened to approach critical psychological levels, even though official data may be slow to come out. Market participants will be able to perceive the dong's genuine worth, undistorted by artificial suppression, thanks to the SBV reference rate mechanism and band widening, according to analysts. As previously mentioned, Vietnam adjusted its fluctuation range from 3% to 5% in 2022-2023. You might be wondering why a stronger currency would be bad for Vietnam's exports since the country is export-oriented. It's a reasonable inquiry. Yes, it is true that exports can become more expensive for overseas customers when the currency strengthens. However, subtlety enters the picture at this point. It seems like Vietnam is certain that its competitiveness in exports is based on more than simply low-cost currency. It's also about value-added manufacturing, productivity, access to global supply chains and trade agreements. A low-value currency fosters inflation, capital flight risk, and the perception of fragility, so the reasoning goes, let the currency increase somewhat to indicate strength instead. Put simply, Vietnam is shifting its focus from exporting cheap currency to exporting effective economic models. Allowing the currency to convey strength is necessary for that change. Therefore, although export margins in the near term may see some pressure, Vietnam's approach may place a higher value on the benefits in the medium term, such as improved global position, increased investor confidence, and more sustainable growth. The most important thing for those who watch this channel, and are interested in the Iraqi drachma and other emerging market currencies to remember, is that a benchmark impact is created whenever a big developing economy changes its monetary policy. Other developing economies in Asia and beyond that rely on exports may have to change their currency settings or cope with increased competition. If Vietnam is perceived as advancing toward a stronger, more flexible currency, this calls for a reassessment of reserves and a reallocation of money, as well as increased currency volatility. Thus, trade chain movements, risk appetite for developing economies, and global investor flows are all relevant, notwithstanding the Iraqi Dinar's IQD location outside of Southeast Asia. Some investment or money may shift away from other emerging economies if Vietnam manages to entice more foreign capital, supports a stronger currency, and lures manufacturing from other countries. There is a systemic link rather than a direct one. This is a move that should be actively monitored by anyone who keeps tabs on currency devaluations, revaluations, trade, repercussions on balances, or capital flows. What could happen next? For the simple reason that the subsequent acts are what one watches for when one suspects a nation is undergoing a regime change. Some of the things to keep an eye on are these. 1. Press releases issued by the SBV. If they make public pronouncements that might indicate broader prohibitions, greater leeway or upcoming changes. 2. Stats on foreign reserves. It may be an indication of support for further currency strength if Vietnam's reserves expand or if they change allocations. 3. Data releases for trade. This is especially true if Vietnam's export growth keeps up despite the rising dong. That would lend credence to the idea that a stronger currency is having no negative impact on competitiveness. Moves in regional currencies are the fourth factor. There can be a ripple effect throughout Asia as a whole if nearby currencies start to fluctuate as well. Number 5. The movement of money from outside. Investor confidence in Vietnam and its currency will be bolstered if foreign funds allocate more capital to the country's stock and bond markets. You might think of each of these as a small step toward a larger change. The timing of Vietnam's move is intriguing from a policy standpoint, as well. Vietnam has a good chance of capitalizing on the global manufacturing outflow from China, supply chain restructuring and renegotiated trade agreements. Among its many free trade agreements are those with the US, Japan, and the EU. Improving infrastructure, increasing exports, and gradually upgrading banking and payment systems are all positive developments. The currency shift is thus not an isolated event, it's a strategy for the future. The plan's outward manifestation is the Dong's leap. The currency's credibility on the global stage is enhanced by reforms in digital payment systems, banking, industry enhancements, and capital market liberalization. According to the findings, Vietnam has been trying to update its banking and payment systems, change its monetary policy framework, and bring its currency policy in line with these changes. There are a lot of good things about the transfer, but it might not go off without a hitch. Prior to anything else, exporters used to lower dong prices may feel pressured if the government permits a stronger currency. If they are unable to increase productivity quickly enough, it could hinder growth in some areas. As a second point, there are still worldwide barriers. US dollar strength, supply chain inflation pressures, geopolitical shocks. It is a tightrope walk for Vietnam to keep export volume steady while allowing the currency to appreciate. Furthermore, if there is a change in global risk appetite, funds may withdraw from Vietnam, which would weaken the dong. This is the third point about emerging market capital flows. Fourth, the issue of inflation is still a worry. Imported inflation can be reduced with a stronger currency. Yet internal factors like as salaries and home credit may continue to quicken. Indeed, numerous uncertainties surround the policy mix and exchange rate in Vietnam, according to specialists. What does this signify for potential investors? Let's find out. The Vietnamese market might soon become a more alluring place to invest in emerging Asian currency, funds, stocks, or debt. Gaining value in a currency increases investor optimism, decreases the currency's risk premium, and encourages bold FDI. New opportunities may arise if the Vietnamese dong is involved in increased international trade, settlement flows, or regional payment systems. Vietnam has the potential to become a relative outperformer for portfolios that incorporate developing market currencies. Contrarily, investors in nations with less robust monetary systems may see an increase in risk as a result of comparisons to Vietnam's change, which will expose these countries' underlying structural vulnerabilities. Volatility could rise, but new possibilities could also appear for currency traders. The lesson here for anyone keeping tabs on the Iraqi dinar or any currency like it is that government change is important. A single day's change in government policy is insignificant. Manufacturing and trade flows are two topics we should discuss. The strengthening of the Vietnamese currency has the effect of increasing the country's cost base in dollar terms, which can put pressure on export and manufacturing margins as well as reduce productivity gains. That, though, could be precisely where Vietnam finds its self-assurance. More value-added production, less dependence on cheap labor, increased use of robots, and stronger international brand alliances. At that point, the change in currency becomes an indicator of maturity. We are advancing from a state of low-cost labor to one of global competitiveness. This might serve as a wake-up call for other Southeast Asian or South Asian nations that compete with Vietnam in the industrial sector. The competitive landscape will change if Vietnam starts to charge higher prices while keeping its export growth rate constant. This might cause shifts in regional trade, investment priorities, and supply networks. A business may elect to go with Vietnam even though it isn't the cheapest option anymore because of the country's political stability, logistical efficiency, and currency stability. The calculus is altered by that. Now let's talk about the region-wide ramifications. Other nations might feel the heat if Vietnam announces a stronger currency. Vietnam might pose a greater threat to export-heavy countries whose currencies decline in value. Devaluation, increased output, or a change in strategy can be necessary responses. As a result, the region's currencies may realign to reflect the changing realities of commerce and manufacturing, a phenomenon that some experts refer to as an Asian currency reset. Currency markets, interest rates, and international capital flows could all be affected if it occurs. Because of this, international investors will need to reevaluate the region's currency risk. It necessitates that governments be ready to react. Currency analysts, like those keeping tabs on the Iraqi Dinar, need to pay attention to regional factors in addition to a single country's currency. Where does this leave the Iraqi Dinar channel in light of all this? Just why is Vietnam being brought up? The Iraqi Dinar may be physically far away, but the world of currencies is interconnected. Where to put their money when it comes to emerging markets is up to investors. Investments that were considering going to less well-known markets may change their course if Vietnam becomes more appealing. Currency risk is measured against a new benchmark if regional currencies stabilize and appreciate. As a result, developing economies with stronger currencies may cause markets to re-evaluate nations like Iraq. The dinar's official policy will not be directly affected at this time, but the climate in which choices on currency policy are made on a worldwide scale is changing. So, keep an eye on Vietnam's action if you're interested in emerging market currencies or are a currency investor. Let me show you a few things on the watch list right now. Things that will need your attention in the coming weeks and months. Pay close attention to the SBV reserve first. One indicator would be a stronger trend in the daily-weekly central rate. Secondly, keep an eye on how the X-band adapts. The dong will have greater freedom if they widen much further. Additionally, keep an eye on the amount of money in the bank. Changes to the composition of Vietnam's reserves or an increase of L are likely to confirm policy back. Fourth, if international investment funds purchase bonds issued by Vietnamese equity companies, money will come into Vietnam. Affirms the trust of investors. 15th, patterns of export growth in Vietnam. This approach will be strengthened if exports remain robust even when the currency strengthens. Lastly, changes in nearby currencies. The spread of the ripple will be seen by the response of other Asian export currencies. Policymakers' remarks are loud. Does Vietnam's currency seem to be changing from being cheap? Attitude is crucial to a robust economy. By keeping tabs on these, you may anticipate if the current regime change is temporary or long-term. Allow me to take a step back and think about this. Facts and figures aren't the only things at stake here. What it stands for is important. For a long time, the dong was considered a regulated currency within Vietnam, and was therefore undervalued. There was no worldwide standard for it. Clear message: Vietnam is prepared to stand up. This move, this leap, this regime transition is acceptable. The world should honor its currency. Furthermore, the storyline is altered by such a message. In order to take advantage of cheaper exports and quicker growth, investors in emerging nations have been capitalizing on weak currencies for decades. However, there are risks associated with such paradigm, such as inflation, capital flight, and the impression of fragility. This might change the way export economies are modeled if Vietnam starts to move away from that. The world's trade currency markets and the evolution itself are both affected by this change, so that's the point. Last but not least, let's tie it all together. The secret mechanism that causes the dong to move is more than simply a little tweak. An important policy change has occurred. There is evidence that Vietnam is repositioning itself, as the SBV is expanding its band, becoming more flexible, moving toward the market, and determining its worth. Capital flow changes, regional currency realignment, more stringent export competition, and more investor concentration are all possible outcomes. This necessitates a readjustment of risk and opportunity for those keeping tabs on emerging markets. The emerging market. While the Iraqi dinar isn't directly affected, it is part of the ecosystem that is affected by changes in global flows and currency policies. This is a time to be vigilant if you are following currency markets. The dong still has a ways to go. To be honest, it's only the start. To finish this movie, pay close attention to the announcements, data on reserves, numbers for trades, and flows of capital. To show your appreciation, click the like button if you thought this breakdown was useful. More individuals who are interested in the situation can see the video. Things are happening quickly, so make sure you subscribe and enable notifications so you won't miss our next update. We'll be keeping an eye on whether the movement of the dong becomes a pattern or just a temporary phenomenon. Everyone, I appreciate you tuning in. All currencies, including the Iraqi dinar, will be monitored closely. And until our next video, take care.